You're standing in the cereal aisle doing mental math on blueberries versus budget when a wild thought appears. What if the government actually helps pay for some of this kid stuff? Surprise? It does. Not out of pure kindness, but because raising small humans is expensive and society wants you to keep doing it without auctioning your sanity. Start with the headline act, the child tax credit. Think of it as a dollar-for-dollar coupon on your tax bill for each qualifying child under a certain age threshold at year end. It's not a deduction that merely trims your taxable income. It's a credit that hits your tax directly. The credit starts generous, then phases out once your income climbs past set thresholds. That phase out is not a cliff. It's a dimmer switch. Earn more, credit fades. If your credit is bigger than your tax, part of it can even be refundable, which means the IRS can send you money back beyond just wiping your bill to zero. The catch is doing the basics right. Claim the kid as a dependent, make sure they lived with you more than half the year, confirm they're a U.S. citizen or resident with a valid taxpayer ID, and pass the age test. Miss any of those, and the discount politely exits stage left. Now meet the sidekick that quietly saves middle-income families thousands. The Earned Income Tax Credit. If you work for pay and your household income sits below certain limits, adding kids to the picture can turbocharge this credit. It's fully refundable, it grows as your earnings rise through a sweet spot, and then it phases out. Many eligible parents miss it because the rules look scary on first read. The spirit is simple: real earned income, qualifying kids who live with you, and the patience to answer the software's questions honestly. Do that, and the EITC can transform a lukewarm refund into a rent and groceries victory lap. What about childcare? The line item that makes you consider teaching your toddler QuickBooks. Two levers exist: a tax credit, and if your employer offers it, a pre-tax dependent care account. The Child and Dependent Care Credit pays you back for a slice of eligible care so you, and your spouse, if filing jointly, can work or look for work. Daycare, preschool, before and after school programs, day camps, and in-home care can qualify. Overnight camps don't. You'll need the provider's legal name, address, and taxpayer ID. Pay with a traceable method, keep receipts, and note the purpose. The percentage the credit covers steps down as income rises, but it rarely drops to zero, which makes it worth claiming even for higher earners. The sibling option is the Dependent Care FSA at work, where you set aside pre-tax dollars from your paycheck to pay those same expenses. Money goes in before income and payroll taxes. You spend it on eligible care, and you reimburse yourself. Use it or lose it rules apply, so choose an amount you'll actually spend. If you have access to both the credit and the FSA, the law coordinates them. Often the biggest win is running childcare costs through the FSA first, because it dodges income and payroll tax. Then claiming the credit on the leftovers if allowed. If you're self-employed, you generally don't get the FSA, so the credit becomes your main engine. Filing status can be your stealth superpower. Head of household is designed for unmarried parents who pay more than half the cost of keeping up a home and have a qualifying child living there more than half the year. It offers a bigger standard deduction and better tax brackets than single. If you're legally married, you're usually choosing between filing jointly or separately. Married filing separately can torpedo credits, so avoid it unless a specific reason, like student loan repayment strategies or liability separation, outweighs the damage. Divorced or separated parents face the classic puzzle. Who claims the child? Only one of you gets the dependent. The residency rules generally favor the parent the child lives with most. Some rules can let the non-custodial parent claim certain benefits with the right signed form. What you can't split is the same child for the same benefit on both returns. The IRS tiebreaker rules are boring and ruthless, so agree in writing before filing season. New babies come with new paperwork. Get your child a social security number as soon as possible. It's the key that unlocks credits. Keep birth certificates, adoption decrees, school or medical records, and proof of address handy. They become your evidence if the IRS asks you to prove that your child lived with you. If adoption is part of your story, the adoption credit can help pay for domestic, international, and special needs adoptions. It's not refundable, but unused amounts can often carry forward to future years, so save every invoice, travel receipt, and agency statement like they're heirlooms. Kids get sick, braces happen, and adulthood contains co-pays. Medical expenses can become tax value in two lanes. The first is itemizing. You can deduct the portion of your family's unreimbursed medical and dental costs that exceed a percentage of your adjusted gross income. That includes premiums you paid with after-tax money, doctor and hospital bills, prescriptions, and even certain travel for care. If you're anywhere near that threshold, consider bunching elective procedures into a single year so the deductible portion actually clears the bar. The second lane is smarter. Use a health savings account if you're on a qualifying high deductible plan. HSA contributions are pre-tax or deductible, grow tax deferred, and come out tax-free for qualified medical expenses for you and your dependents. It's one of the rare triple wins in the code. And yes, paying for your kids' orthodontics from an HSA can feel like legally printing money. Now let's peek ahead to education, because future tuition has a way of arriving sooner than you think. A 529 plan is your greenhouse. Contributions grow tax-deferred and qualified withdrawals for education are tax-free. Many states sweeten the deal with their own deductions or credits for contributions. You can change beneficiaries within the family, roll between plans when rules allow, and even use limited amounts for K-12 tuition, trade schools, and certain apprenticeships. Always check current rules before moving cash. If your child earns a big scholarship, you can withdraw that amount without the usual penalty on earnings. You'll still owe income tax on those earnings. Keep every bursar statement, roommate of receipts, and proof that distributions matched qualified expenses in the same tax year. Coordination matters, especially if you're also chasing federal education credits later. Speaking of credits, once your kid hits college, 2 federal stars walk on stage. The American Opportunity Credit focuses on the first 4 years of higher education, covers tuition and required materials, and is partially refundable. The Lifetime Learning Credit is more flexible, undergrad, grad, or skills courses, but non-refundable and capped at a lower amount. You can't use both credits for the same student in the same year, and you can't double count expenses paid with tax-free 529 money. This is choreography, not chaos. Line up tuition bills, scholarships, 529 distributions, and credit-eligible costs, so each dollar does as much work as possible. Sometimes it pays to let the student claim a credit, sometimes it pays for the parent too. Software can run both scenarios, but only if your records are clean. Let's talk about the kiddie tax, a phrase that sounds like a cartoon villain but exists to stop parents from shifting investment income into a child's lower bracket. Above a modest threshold, a child's unearned income, interest, dividends, capital gains, can be taxed at the parent's marginal rate. This doesn't ban saving for your child. It just encourages using wrappers like 529s, or focusing a child's taxable accounts on growth that you won't sell until later. If your teen is working, that's earned income, not kiddie tax bait, and it can even open the door to a Roth IRA for minors. Parent funded up to what the child actually earned, growing tax-free for decades. That's the most wholesome loophole in finance. Credits and deductions love proof. For childcare, you need the provider's info and receipts that show dates and amounts. For the child credit and EITC, you need residency proof, school records, medical records, lease agreements that tie the child to your home more than half the year. For medical, you need itemized bills and proof of payment. For education, you need the official tuition statement and a ledger that shows who paid what and when. For 529s, you need distributions and matching expenses inside the same calendar year. This isn't busy work. It's how you convert maybe into yes when a letter arrives. There's a quiet chapter on health insurance and the premium tax credit if you buy coverage on a marketplace. Adding dependents can increase the size of the credit that helps pay your monthly premiums, but it's an advance and reconcile system. If your household income ends up higher than you estimated, you may repay some of that advance. The fix is updating your marketplace application when your income changes and saving every monthly statement. Families who ignore their mail get refund shock. Families who update their numbers on time get calm. Divorce and separation deserve one more careful paragraph. Child support is not deductible to the payer and not taxable to the recipient. Alimony can be deductible, taxable, or not, depending on when your divorce agreement was executed. Recent agreements usually make it non-deductible and non-taxable. If you're negotiating, understand how who claims what impacts both households. Sometimes it's worth trading the dependency claim in exchange for a cash adjustment that leaves everyone better off after tax. Write it down, sign it, keep it. If you run a business or freelance with kids in the house, a few more levers appear. A legitimate family-owned business can hire a teen to do real work at a reasonable wage, document hours and tasks, and shift some income into the teen's lower bracket, still subject to payroll realities but potentially powerful when done right. If you're self-employed, you can also deduct the health insurance premiums you pay for your family, subject to rules and limits, which can be worth far more than people realize. And if your business actually conducts research or builds product, the R&D credit doesn't vanish just because there's a stroller in your hallway. It's there if you meet the tests. All of this is starting to sound like a lot, so zoom out. The family tax system is a set of rails designed to lower the cost of raising children if you meet society halfway, by working, documenting, and filing on time. Your job is to make a tiny habit stack. When a new child arrives, apply for the Social Security number, add them to health coverage, and update your withholding or estimated taxes so you're not over or underpaying. When you pay for childcare, use one card and one bank account so your year-end report isn't a scavenger hunt. When school begins, keep the enrollment letter and attendance records in a folder called Tax Proof, Kids. When braces get installed, drop the invoice in Medical. When you open a 529, automate the contribution so future you doesn't skip months. Once a year, run a 5-minute checklist. Do I qualify for head of household? Did I claim the right child on the right return? Did I coordinate 529 withdrawals with education credits? Did I leave money on the table by forgetting the EITC? There's also the human side. People delay filing because they're worried they'll owe, or because life with kids is a loop of sticky fingers and lost login passwords. Here's the counterscript. Filing is how you get paid for the chaos. Refundable credits flow only through a filed return. Payment plans exist if you owe. Extensions buy you time to file, although not to pay, and they prevent penalties for late filing. The worst timeline is silence. The best is honest paperwork with proof. So, is it true? Do you really get a discount for having kids? The answer is yes, with an asterisk. It's not a free pass. It's a pile of levers that move real money when you pull them early and document them well. A credit that erases tax. A refund that shows up because you worked and your kid lived with you. Pre-tax dollars that paid for daycare and never got taxed in the first place. Medical costs that finally leapt the threshold because you planned them in 1 year. College savings that grew under glass instead of out in the open where every dividend was taxable. A filing status that quietly put you in a better bracket because you carried the household alone.